Here we are, Chapter 18, Part 3, Rewarding Investors. So, overview, dividends. Distribution of assets the company has earned on behalf of its shareholders. Dividends are paid, assets earned by the company. Management is returning to shareholders a portion of their investments. Cash dividends reduces retained earnings and total equity. Liquidating dividends. Dividends exceeds the balance in retained earning. The excess is referred to as a liquidating dividend. Any portion of a dividend not representing a distribution of retained earnings should be debited to additional paid-in capital. Property dividends, non-cash assets, distribution to shareholders as dividends, should be recorded at fair value of the asset to be distributed, as in a non-cash transaction. And stock dividends. Distribution of additional shares of stock to current shareholders of the corporation affects neither the assets nor the liabilities of the firm, and shareholders' proportional interest in the firm remains unchanged. Very important. Cash dividends. No legal obligation exists for paying dividends to shareholders. This has to do with common stockholders. Liability is not recorded until a company's board of directors votes, but that's when the liability is recorded, when they vote to declare a dividend. Directors declare a cash dividend. That's when you record the liability. Before the payment actually can be made, a listing must be assembled of shareholders entitled to receive the dividend at a specific time and date. That is not recorded. And then retained earnings is reduced. It's always a cash dividend. Liability recorded. Now, let's go. Now, stock splits. Increases the number of shares outstanding. A stock distribution of 25% or higher can be accounted for in one of two ways. As a large stock dividend, you only book the stock split affected in the form of a stock dividend. That's what we call it. As a stock split, thus a 100% stock dividend could be labeled a 2-for-1 stock split. Now, when you treat it as a stock split, there's no journal entries. Okay? No journal entries. You just change the par and you change the number of shares. Accounting for a large stock dividend as a stock split affected in the form of a stock dividend avoids the change to the records by recording an entry to change the balance in the stock account. Now, this is what most people like to do. So we're going to go through some examples and I'll show you the difference. Now, here's our example. This is what the balance sheet looks like, and we will use this example to demonstrate property dividends, stock splits, and cash dividends, and what effects it has on total shareholders' equity. Now, on March 1st, the Board of Directors declared a property dividend of 240 shares of Company B's common stock that Mike had purchased as an investment. The book value was $700,000, but the fair value is $3 per share. The date of record was the 15th, and they were issued on the 31st. So, on March 1st, we need to make an entry. But first, what we need to do is we have to adjust the investment to fair value and record the gain or loss. So, in this case, investment in B company, we're going to increase it by $20,000, and we're going to have a gain on investment appreciation. Then we're going to record the liability for the property dividends payable, and we're going to take it out of retained earnings. Now remember, it was on the books at $700,000, but we increased it to $20,000. Then we're going to make, now the date of record, we do nothing, and then we're going to pay it out. So that's what it looks like when we have a property dividend. The rule is you have to first adjust to fair value, record the gain or loss, and then you record the property dividend. So what we've done based on this is taken $720,000 out of retained earnings. And when you have a cash or property dividend, it is always going to reduce total equity, whereas a stock dividend does not, because you're just moving it out of retained earnings into common stock and additional paid-in capital. And you'll see that a little later. Now, the next thing that happened on March 3rd, we had a 5-for-4 stock split was declared. The stock split was effected in the form of a 25% stock dividend. The fair value of the $1 par was $11. So here's our journal entry. Now, what's the rule? Since this stock split was treated as 25% stock dividend, then you journalize it as a large stock dividend and reduce paid-in capital, common stock, and retained earnings at par. Remember, we do not pay dividends on treasury stock. So, we're going to take paid-in capital, excess of par, and we're going to take we have 364 shares of common stock minus the 4,000 treasury stock times 25% times 1. Then we're going to book the common stock. Now, here's the rule. Whenever you have a large stock dividend, you record it at par. Okay? You record it at par. You don't care about the fair market value whenever it's a large stock dividend, because they don't want you moving all that stuff around so much. So now what's happened is common stock has gone up by 90 shares as well as $90,000, and we've taken it out of paid-in capital in excess of par. Now, on July 5th, a 2% stock dividend was declared and distributed. The fair value of the $1 par was $11. Now, we do not pay dividends on treasury stock unless specified, or we only pay on outstanding, issued minus treasury stock. So, we're going to take 364 plus the 90 minus the 4 equals 450 times 2% times $11 is the fair value. We're taking that out of retained earnings, and then we're going to distribute it to common stock and additional paid-in capital. Now, the next thing that happened is on December 1st, the board declared an 8.8% cash dividend on the preferred stock, and the date of record was the 20th, and the payment was on the 28th. So, we would take it out of retained earnings, which would be, it only has $1 par, so it would be 0.88 cents, so times 90. And we're going to record a cash dividend. Now again, this would reduce total shareholders' equity because it's a cash dividend. Date of record, we record nothing. And then the date of declaration, date of distribution, we would pay it out and reduce cash. Now, on December 1st, the board declared a 50-cent cash dividend on the common shares with the date of record of the 20th, the payment on the 22nd. So, we're going to take 364,000 shares plus 90 plus 9 minus 4 equals 459 times 50 cents. And we're going to record it as a cash dividend. This also would reduce total stockholders' equity. And then on December 28th, date of distribution, we'd show the payment of the cash dividend. Now we're going to go through and prepare our section of our stockholders' equity based on all the changes that have occurred. And in addition, we had net income of $810,000. So, preferred stock is now, that didn't change because we didn't do anything there. However, our common stock, we now have 463 shares at $1. That's because we took 364 plus 90 plus 9. And now we have our 463,000 there. Now, nothing happened to paid-in capital in excess of par for the preferred. But for paid-in capital excess of par, there we added 90, we subtracted 90, so that really stayed the same. Retained earnings changed the most because of our cash and property dividends. So that changed a lot in terms of well, all of our transactions. So that had the most changes. And now we add it up, and our total stockholders' equity is $14,008,580. And also, if there had been cash and property dividends, if there had not been cash and property tax dividends, our total would not have changed. But remember also, the number of shares has also changed. And that concludes this section of Part 3.